Welcome to our video on the importance of diversifying your portfolio. Whether you're a seasoned investor or just starting out, it's crucial to understand how diversification can help you achieve your financial goals. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate. By doing so, you can minimize risk, increase potential returns, and protect your investments from market volatility and economic downturns. Chapter 1: Minimize Risk. Diversification is a smart way to minimize risk in your investment portfolio. By spreading your investments across different asset classes, you can reduce the impact of any one investment performing poorly. For example, if you only invest in tech stocks and the technology sector takes a hit, your entire portfolio could suffer. But if you diversify by also investing in bonds, real estate, and commodities, you'll be better protected against market downturns. Studies have shown that diversification can significantly lower portfolio risk without sacrificing returns. In fact, a well-diversified portfolio can often outperform one that is not diversified. This is because when one asset class is underperforming, another may be doing well, balancing out the overall performance of the portfolio. Chapter 2: Increase Potential Returns. Diversification is not only a risk management tool, but also a way to increase potential returns. By spreading your investments across different asset classes, you can take advantage of opportunities in various markets. For example, if the stock market is down, your bonds or real estate investments may perform better. In fact, studies have shown that a well-diversified portfolio can provide higher returns with less volatility than a concentrated portfolio. This is because diversification allows you to capture gains from different sources while minimizing losses from any one source. Chapter 3: Reduce the impact of market volatility. Diversification is a powerful tool that can help reduce the impact of market volatility on your portfolio. By spreading your investments across different asset classes, you can minimize the risk of being heavily exposed to any one particular market or sector. For example, let's say you have a portfolio that is heavily invested in technology stocks. If the tech sector experiences a downturn, your entire portfolio could be negatively impacted. However, if you had diversified your portfolio by including investments in other sectors such as healthcare or consumer goods, the impact of the tech downturn would be less severe. This is because the losses in the tech sector would be offset by gains in other areas of your portfolio. Chapter 4: Protect your investments. Diversification is one of the most effective ways to protect your investments from market crashes and economic downturns. By spreading your investments across different asset classes, you can reduce the impact of any single event on your portfolio. For example, during the 2008 financial crisis, those who had diversified portfolios were better able to weather the storm than those who had all their investments in one sector. While some areas of the market were hit hard, others held steady or even saw gains. This helped to mitigate losses and preserve wealth for those who had diversified. Chapter 5: Take advantage of different market cycles. Diversifying your portfolio is not only about reducing risk, but also about taking advantage of different market cycles. By investing in a variety of asset classes, you can increase your chances of success during different economic environments. For example, during a recession, bonds and defensive stocks tend to perform better than growth stocks. On the other hand, during an economic expansion, growth stocks tend to outperform. By diversifying your portfolio across different asset classes, you can take advantage of these market cycles and potentially increase your returns. Chapter 6: Avoid overconcentration in one asset class. Overconcentration in one asset class can be dangerous for investors, as it exposes them to a high level of risk. For example, if an investor puts all their money into stocks and the stock market crashes, they could lose a significant portion of their portfolio. Diversification helps mitigate this risk by spreading investments across multiple asset classes. By doing so, investors can reduce their exposure to any one particular asset class. This means that if one asset class performs poorly, the impact on the overall portfolio is lessened. Chapter 7. Explore different investment opportunities. When it comes to investment opportunities, diversification is key. By spreading your investments across different asset classes, you can reduce risk and increase potential returns. For example, instead of just investing in stocks, consider also investing in bonds, real estate, or commodities. Each asset class has its own unique characteristics and reacts differently to market conditions. By exploring different investment opportunities, you can find the right mix for your portfolio and customize it to your specific goals and risk tolerance. Chapter 8. Reduce emotional investing. Investors are often driven by emotions, which can lead to irrational decisions. Diversification can help reduce emotional investing by spreading risk across different asset classes. For example, during a market panic, investors may sell off all their stocks in a rush to avoid losses. However, if their portfolio was diversified, they would have exposure to other asset classes that may perform well during a market downturn, such as bonds or commodities. On the other hand, during a market euphoria, investors may become overconfident and invest heavily in one asset class. Again, diversification can help mitigate this risk by ensuring that their portfolio is not over-concentrated in one area. By having exposure to a variety of asset classes, investors can stay grounded and avoid making hasty investment decisions based on emotions. We encourage you to take action and start diversifying your portfolio today. Don't wait for the next market crash or economic downturn to realize the importance of diversification. Thank you.